Hello, fellow trader. This is Mr. J from ICTing Deriv. So we're gonna get into the bread and butter of things. We're gonna get our hands steady, and I'm going to show you this thing or this very principle of time. And I'm going to do this by starting with a simple signature. I'm just gonna coin it reversal hour signature. And as we get into what I'll be presenting, it is my hope that you find value in it and that it helps you in your tape reading, your demo trading, right? So, first things first, it's a disclaimer, and it's important that I put this up here. I'm not a licensed financial advisor, and everything that I'm sharing is my personal findings and things that I utilize that benefit me, and it is for you to investigate and see if they can benefit you, right? So this is educational and informational purposes only. It is not financial advisement. You remain solely responsible for the decisions you make with your money, right? So let's get right into it. Algorithmic time signatures and AMD are or AMD commonly known for this. This is something that is common in the ICT community, where we look at price delivery in terms of these cycles of accumulation, manipulation, distribution, and retracement. So this cycle repeats with slight variation, and it is fractal. So basically, when you study uh, the market using this lens, if I may put it, this perspective, where you look to see where the accumulation happens, where the manipulation happens, where the distribution happens, and retracement at the end of that distribution happens, you will begin to see certain time signatures that couple with the AMD. So what do I mean by this? Let me just give you a context, right? So when we're talking about the context of time in the AMD cycle, at the beginning of whatever period it is you're studying, right? Uh, I'm not going to give you time frames for now, but I want you to just look at this in terms of principle. At the beginning of whatever period of time or candle that you're watching that is forming, there will be accumulation, there'll be manipulation, and then there'll be these will be at the beginning of the period, right? And then towards the middle of that period of time, after the manipulation takes place, you get your distribution. And at the end of that distribution, you have that retracement, which happens at the end of time, right? So I'm going to be showing you an example using a classic buy scenario. It's the easiest to uh, project. But when you look at the different candles that we have, the dojis, the hammers, you have all kinds of candles, and these is formed by the variations between these cycles, right? So I'm just gonna give you the very simple version of this so that you can begin to see the time and these stages within the formation of the candlestick. So this is just a visual representation of what I mean. So when you look at the beginning, right, if you can follow my mouse, we have this candle here that we have here. It has wicks. This candle, we are anticipating it will close the way it looks, right? We're at the very beginning here where it hasn't really closed, but we're going to see how we're anticipating that it will close bullishly, right? So, and if you're trying to apply the classic buy scenario, you're looking for market conditions where this kind of a candle is favored to form. So, at the start of that period or candle, you're going to have an accumulation, and then you're going to have a manipulation where people send. the wrong direction, and then the market, after manipulating, distributes, and then we have that retracement, and then now we get into another accumulation phase. It manipulates, it runs, and that is your distribution towards the middle, and then retracement towards the end. It starts the cycle again, accumulates, manipulates, distributes, retraces, all the way till the wick or the high is formed, right? And yeah, that would be there. And then price retraces, and then probably the candle will close somewhere around here, which would be this closing price, and we would have printed a bullish candle like that. So that is the classic buy scenario. So this is fractal, it's in its nature. If you look at this very candle that is here, when you really look at this small cycles, even within the bigger uh, uh, candle that would be forming, you'd see that these would also form something similar to a bullish candle. You'd have the opening around here, you have your wick forming in the manipulation, and then the distribution that forms the body of the candle to the high. And then once the wick of it is formed, there's a retracement and then a close. And then you have a big green candle even inside of the larger uh, green candle or the bullish candle that is forming, right? I hope that is getting clearly to you. So now, when we are looking at the time-based reversal signature, um, this is now at least to have something that you can go out there and begin studying with regards to time. This occurs at the end of a period. If I just go one slide, you can see that the retracements are at the end of the period, right? Or yeah, yeah. So occurs at the end of a period and occurs to unseat the most profitable for that period, right? And this is usually where stops will be trailed, and then it will usually, yeah, like I'm saying, it will run for highs and lows where stops will likely be trailed. Um, so where do you find examples of models using this principle, right? When you have gone through Michael J. Huddleston's or ICT, when you go to his library, you realize what he's actually doing is taking you into the those different cycles and how to trade each one. Now that's a library of over 700 videos or so, but you really have to appreciate the level of attention to detail you need to in order to be as precise as he is, right? And we're all seeing what he has done, and we're all striving for that. I believe I am for one. And while I was trying to figure this out for Deriv, I started looking at his concepts and principles, and that is why I am now able to bridge that gap of time, because most of us have been dealing with price action and we didn't have the missing half, that other half, which I now have in my hands, which is time. So he's always talking about time and price, and I'm going to be talking about time and price. Now, the examples in his library, if you have studied the ICT, that Friday, thank God it's Friday model, where you expect that retracement in during Friday by 30% or so of the range of that weekly candle. Once a target has been met, you can expect that retracement to form during Friday. It's a no-brainer. It's an easy uh, I model to trade, because you are looking at what has happened for the most you're looking at what has happened most of the week, and you are expecting a retracement based off uh, what has happened initially during the week. So when you take it from the weekly and you now bring it down to a session, when you look at uh, the way we trade sessions indices, you realize that towards the end, we have what we've been coming, what we just recently learned, the lunch hour macro. where there's that retracement that happens. There's a way of trading that, and that rules around that, where you 70% or so to 80%, where you always just have a retracement during the lunch hour period, right? And then the other signature of this reversal principle, you find it during the last hour of the PM session, where you look at what price is done, and then when you get into the last hour, you can expect a retracement, right? This is in principle, right? So we went from the weekly, uh, we go down to the session, and you can take this as low as you want in principle, right? So yeah, so let me also just mention that this principle or this signature of that reversal or retracement, let me properly put it, it is a retracement, right? Not a reversal, it is a retracement. This retracement is meant to create the high of the week, right? I hope that you're getting that. It's meant to create that wick on your candles. If it's bullish, it will give you that wick at the top of the candle, right? So that is what that algorithm is doing in principle. So applying the time principle to derive synthetics. So for us to be able to do this, we have to first define session boundaries. There's six of them from my studying and investigation. And you have them here from midnight to 4 a.m., 4 a.m. to 8 a.m., 8 a.m. to 12 p.m., 12 p.m. to 1600 hours, 1600 hours to 2000 hours, 2000 hours to midnight, right? So this is all derived server time. So look at it in terms of the 4-hour candles, right? So even when you go to like your New York session for indices, it's 9:30 to 1:30. That's approximately 4 hours, right? When you look at it. So when you come here, you're looking at these sessions. We have to define the boundaries for us to be able to study this reversal signature in price. And so it's in blocks of 4 hours of price action. So where does the reversal signature for synthetics occur within these sessions, right? It occurs generally beginning from the last 90 minutes of each session. So you have 2:30 to 4 a.m., 6:30 to 8 a.m., 10:30 to 12 p.m., right? So it occurs during that last 90 minutes, right? And I'll go in and show you how we use this information, because you see this, you have the times, but what is the benefit as well? So let me just say, okay, let's go to the next slide so you just see. We have price action, and generally I like this model because it's a no-brainer kind of a model, right? It makes life so easy. If you don't know when the low is going to form, or where it is likely to form, which, like, when I started with time and price is where I started. I would just wait for that last period to come. So you have your manipulation, accumulation, manipulation, distribution. And then because I'm looking at price, I see where the most displacement has taken place. By the time you get to this area of price, you know the guys who are most profitable are the longs, right? In this example. So then you begin to anticipate what what in price action to the left can serve as a premium. And you get that premium and you start seeing price breakdown, you know, uh, it was the shift has occurred, and that reversal signature, that retracement algorithmic signature begins to kick in, and then you can ride, even if it's a small portion of the move, you can ride it to some low also in that price leg that would have formed, right? So how would you go out there and interpret this today? Um, Let me just take you and make you appreciate something as well. Uh, Generally, before I understood this principle, I'd be able to see, okay, this candle is going up, right? But then what would happen is you're trying to get in, okay, you're going to get in somewhere here and say, okay, I see that it's likely going to go up there. And then you get in, and then price runs, you're in profit, you're like, yeah, I got it. And then price retraces, stops you out because you got in late, right? Because you weren't able to catch the very, very turning points at the low or close to the low, right, or the open. So then you're like, maybe I'm wrong, but okay. Then you wait, and then you see price displacing again, and then as it's displacing, you enter. After you enter, then you watch price retrace on you again. You wait for it. You're like, but okay, now I think maybe it's turning. Uh, or you just maybe want to sit on your hands, and then you see it displacing again. You try to enter, it retraces on you, stops you out. And probably at this time maybe you've blown your account or something, right? But that's usually something that is there, and usually some people who get stopped out, it's because of this very principle that they are not aware of, right? I also want you to challenge yourself, go look at your past trades, see if this isn't somewhere in there, right? Maybe you got caught up in one of these cycles. So how do I tape read this today? Do your top-down analysis, right? Uh, Even though I'm saying do your top-down analysis, it's because sometimes it's very beneficial to know what you have in the, as a premium and a discount, right? When you have done your top-down analysis, you've marked your PV arrays, right? That will serve as your premium, your discount. You have now you go and you mark your session boundaries. You identify your dealing range where your higher time frame PD arrays exist, right, within that dealing range. And then you note those PDs in close proximity to price. So even if you may not be able to do a proper top-down analysis, this is the most important part. This retracement signature, uh, we will have a, I will give you another lesson where uh, I give you a bit more detail as to when it fails, but I would also like for you to try and study that when you are tape reading and looking for your 5 bullish examples, 5 bearish examples, as I've given in the first presentation for this community, right? So identify which side would be in profit, mark the lows where stops would be trailed for bearish last hour time bias. That is, price has moved up most of the range, and you're expecting towards the end of that session that there will be a drop, right? So, or mark the highs where stops would be trailed for a bullish last hour time bias. So price has been going down. It has left some highs and it's going down. You mark those, and then I try to study how price runs for those highs during the last hour. So as soon as you're in deep discount, you can anticipate. So discount in your range that is to the lower side of it. When you reach deep discount by the last hour, you can anticipate a retracement up. And if this is for a bearish scenario, if you are in deep premium, that is on the upper portion of your dealing ranges, you can anticipate price going down, right? So let's just go to my general case study. This is 29/11/25. This was on V75 oneness, right? So yeah, from my trade journals, we're gonna start here and look at it here. Okay, so when we begin to study this signature, I was looking at V75 1S. So I'm well versed enough to do a detailed top-down analysis. And just recently, we've been studying about grading weeks, and I've done my part of studying it. And so whenever I start, I'll do this very exercise where I look at weekly, daily, and just go down the time frames enough to give me an idea of what I'll be working with in my smallest time frame, right? So I have that candle right here. It has a wick to the bottom side of it. I have graded that. Uh, yeah. So one thing also to note, you can see the price here, the price line, right? And there is also this wick that I did grade, though I didn't show it here. And that's the wick that you see here. It's quadrant, right? And then right at the get-go, uh, I didn't properly screenshot this, but I hope you are able to appreciate just that price had done a significant drop, right? Price has just done a significant drop, and now down to the last 90 minutes, you can see that it has been consolidating here. So straight away, you may be saying, okay, most of the session is bearish. So what I can expect is a retracement on the people that are profitable. And who would be profitable? It's the people who are selling as prices going down. And then we start to go in and look at how or where they would trail their stops, right? So for this example, I'm going to use the low hanging fruit, right? And it's usually advantageous to also look at other high time frames besides this one. So this is M1. I've established that I want to be bullish for this very, very last hour. If you recall the sessions, they go in 4 hours, and this is the range from 1600 right here to 2000, right? So uh, yeah, price on the 15-minute, you can see the session. It starts somewhere up there, which I didn't include here in the screenshot. But the focus for me was this separation between this candle, these two down candles, right? That is a fair value gap, the CB. And then we have this candle here that works into that and leaves a high. So that is the high that I was targeting because it has a fair value gap next to it, right? So that is the target that I had uh, for a low-hanging fruit. So right away, you can just see the comments that I was making here. I didn't like how price was just stuck in a range, waking up and down. And because of this, I needed to be convinced enough that price would move for me to engage it. And by the way, this is a demo account. I'll just keep saying demo account, right? When you go in and study this, use your demo account. So yeah, then I had that displacement that once it occurred, I knew, okay, now the algorithmic signature has begun, right? So I'm watching it run up there. I'm like, okay, I have now that market structure shift here, and I'm just waiting to see if I can get a fair value gap. So then immediately it gives me a volume imbalance right there. And the way it has displaced in just a single minute from here to here, it was very quick. I knew that price was going to run. So the odds of me getting a fair value gap where price retraces down into uh, have significantly dropped. So I knew immediately then I'm going to engage on this volume imbalance, right? So as it retraces into the volume imbalance, I'm entering right there. And then quickly, just after entering, it's up there. So that is the history of it. And you can see that price after just after that drop now is beginning that cycle of retracing on those who are profitable and going for their stops. And then just that comment entry on the retracement into the volume imbalance so that it's clear what I used. Volume imbalance is just one of those PDRAs that we have been taught. And one of the things to consider, it was where it was coming from. That I need a bit of respect from discount. In fact, I misspelled discount, but yeah, discount PDs to take action. And you can see here that order block is what sent price up. And then immediately when I saw that big displacement, I knew that now I can engage. So when you look at it and how far it went, you can see that it really did retrace quite a lot. Even though I was only aiming for the low-hanging fruit, you can see how price then retraced. And here I actually have the clear session start, the high of it down to the low. And you can see that in that drop, there are some sell side that was, or sell stops that were taken here, and price was in a deep discount by the time the last 90 minutes of the cycle began, which is roughly around here, the last 90 minutes. And in that last hour, that's when we had that run up, right? So this is how you use this information, right? So I've given you a bullish scenario. Now I'm going to show you a bearish scenario uh, that I engaged in just recently. So we're gonna just go here back to the trade journal. So this is yeah, this is the month 11 on the 22nd of November. That is the general case study that we're going to be looking at, right? So let me just pull this up, right? So we're starting with the higher time frame. I was looking at the daily here. You can see that I'm grading the the premium week, right? We call it a premium week, and I dropped some lines there to show the levels within the wick, and then we go down to the smaller time frames, right, and then see how we're going to engage price. So already I'm expecting some draw up into the buy side, right? So I'm more inclined towards seeing price going up, right? So I'm now down here. As soon as I drop, by the way, you can just see even the time marker there. As soon as I got down, I was watching price and marking some PDRAs to consider and use during that time. So I have this fair value gap that I've marked here, and this is the daily wick lower quadrant. And you can see how beautifully price respects this fair value gap, and then you had that big displacement. So I was watching this and I was like, okay, now I know uh, I'm in the early portion of the session. And if that is the case, I can anticipate price rallying towards the draw on liquidity. Uh, this is, let me add context to it and just say, it is important before you engage price to know uh, at the very beginning of the session, if you are expecting classic bullish scenarios or bearish scenario, you have to know your high time frame bias. So I had my bias, which is that buy side, but more importantly, those quadrants I was trying to get from what one quadrant to the next, right? So you can already see the other quadrant right there, which I will annotate because I did have to engage before I was just done making my annotations. So immediately there's a volume balance that I'm entering in. Right there, you have a fair value gap right there, and I'm saying I prefer it remains unfilled to act as a breakaway gap. So the important thing is not in necessarily the trade, but in the utilization of that time principle. So session began, it manipulated uh, or went deep to discount that, and then it ran up, and then this is just the distribution phase of it, right? So I'm entering, I've graded from here to here. I'm taking and annotating the levels at which I would like to collect partials, right? So I collect something here because I was watching price the way it was reacting here. It looked like it may want to give a drop. But in terms of using price, this was towards the middle point where you have your distribution phase when you look at that chart that I made. So I got my partials, and then unfortunately price then retraced on me, right? And then I was just watching price yeah, and then there was that fair value gap right there. And then as I was watching this fair value gap and the way price just dropped and then fell short here of this projection. And but you see price now having left these relatively lows. This is what I was watching when I was weighing my options, because I'm now at that last 90-minute cycle, right? You can see that it's marked there, and I'm trying to engage it and go short, but unfortunately I get stopped out, right? So immediately I knew, okay, it'll go up and hit that premium wick, cortical encroachment, or the midpoint of that wick. And then this very fair value gap that I got stopped out on, I knew it would become inversion fair value gap. What simply that means is that it will change its property, right? Instead of being used to go up, it will be used to go down, and I can engage in it. And that is what I'm annotating here. That is the beautiful thing about understanding price and time, or time and price. So price goes to that daily premium wick midpoint where I had just made my partials up to that point, right? And then price immediately drops, like a big drop. And as I was watching it, as it was getting here, I'm like, okay, it's going lower. So I immediately entered in there, and what you see here, just this small portion here, is what I've zoomed in into, right? You can see that those things when you go to that previous screenshot, and price is dropping. And I'm using that signature of time and coupling it with price action to decide that, okay, this is where I'll go. Price will go down, and it'll use that fair value gap to go down. And if you see where my take profit is initially, right, it's here, right? Uh, that is the low hanging fruit where I think, okay, price will likely get down to from here. And then price goes to the low hanging fruit. It was at the top of that uh, right here, right? So you can see I did collect some partials along the way, and eventually I do close it out. I did try to say maybe it may run to this sell side that I initially had in mind, but it didn't. So eventually I closed the trade out here. But the principle is in understanding or utilizing that time signature for that last hour, right? Price, when you look at it, it had displaced up quite significantly, right? Quite significantly from here. It ran all the way up there. And then after this bullish run, I knew, because we had reached a dip premium. And if I had not done my top-down analysis, maybe I wouldn't have had the confidence to know that, okay, this is a good turning point for price. But because I had that wick marked with its quadrants, when I saw that, I knew it would drop, right? And I could trust engaging price in the drop. And that is the signature that you're seeing here. So back to our lesson. So that was the first general case study for the 29th, and for the second, where at the very beginning of the session, price was bullish. I was bullish. I reached the deep premium wick CE. I don't want to get too much into the breakdown of the trade, but I'm more interested in how I was using time in it, right? So that you can appreciate that. Though you may see, you saw many things happening there, many things. Why did I choose those fair value gaps? All that. That is not for this lesson. It's maybe for another follow-up if someone is interested in that. But the interest here is time. So for the last hour, I was trying to target those equal lows, but I did have my low hanging fruit target that you saw. And that is how you can just go in and utilize this signature in price, right? So how does this really benefit you when you start to anticipate prime moving on these? I call it the time-based bias. Yeah, time-based bias. That time-based bias where this one will be the easiest because you don't need too much information on your draw on liquidity. it is important to at least be able to see highs and lows when you get into that. And when you begin to tape read, you will see very specific ones that become your low-hanging fruit target, because that's where you want to start, right? That's where you want to start. Um, Otherwise, I hope this was beneficial to you. I want you to go and study this in your different symbols for derive. Uh, in my little studying, right? In my little studying, I've seen price for boom and crash in that very last hour throw some really big wicks or candles or spikes, right? For boom and crash, it's so big. If you were trying to go against those spikes, you'd be left wondering where this came from. But now that you have this information, you know how to utilize it, maybe to preserve yourself from getting hurt in the marketplace. And more importantly, you can anticipate these small waves of retracements and you can ride those. And in that last example, you saw that I went up, I tried to go down, got stopped, but I knew then I would be still able to ride that last wave going down using that time-based bias signature towards the last portion of the session. So thank you for your time here. I hope you do watch this once or twice and try to look at everything that I've shared with you in principle, right? Because what's important is the algorithmic principles. And in the video description below, it's the second chart indicator. Um, I've been using this little tool for a while now, and it has opened a whole new world to me. I'm not saying go out there and try to trade the seconds chart. You, for some of you who feel it is noise, I am telling you, you have no idea what you're missing out in terms of seeing the building blocks that make a price. So just down in the description, I've left the link to my website where I've made it free and it's not mine. There's this guy who I have to give credit to. It's called Peter Thomet from GitHub IT, something like that. Yes, Peter Thomet made this indicator, and it goes as far as to show you the 5 seconds, 15 seconds, 20 seconds, 30 seconds, even the tick chart, right? But I'm just saying, take it, plot it for your 15 seconds, put it in your Deriv MT5. For you to actually be to use this, you'd need your computer, right? Put it in there and see the sub 1 minute market structure and see why I decided to leave out that whole idea of a time frame when I was showing you the classic buy day scenario in the schematic, right? When you have that and you start looking down into even the sub M1s, that very idea that you can trade an hourly candle, like like treating it as a daily candle and trading it, you actually get that world opening up to you because you can see even that sub M1 structure, right? So I'm just saying go out there and study with it. I did a bit of studying, not a bit, a lot of studying before I even decided to try and incorporate it into my scalping because I'm a scalper by nature, right? So look at that. It's a free gift from me to you. If you want to get it at the source, you'd have to copy the code, put it in MetaTrader editor, and then get the indicator, then put it into your MT5. But I have done all that, and I've just given you that very last portion where it has been uh, put into its proper format just for you to copy and paste in your data folder for your MT5 and then start observing price in the sub M1 chart. And that is what I have done and done some screen recordings of executions actually showing I was using that very indicator. So thank you very much for your time and stay blessed.